Let's continue on with the July market report. Core unemployment. If we look at that graphically, we see that the overall unemployment rate falling right now. Core unemployment has grown from May to June, and certainly from April to May. We're going to continue to watch this. If you want to compare that back to April 2010, where half of core unemployment was back then, much lower, right? And when you look at this, it brings up a lot of questions. How is unemployment going to affect the overall economy? How's it going to affect our business? It brings a lot of questions then to, are we about to see a wave of foreclosures? Question on many people's minds, really up to Congress right now. We've covered a lot of this. We've talked about how we see the foreclosures playing out and how this is different from 2008. Black Knight brings some very good information here, and they tell us of all the active forbearances, meaning those that have paused their mortgage payments due to financial hardships and unemployment, things like that. So of all the active forbearances which are past due on their mortgage payment, 77% have at least 20% equity in their home. Different from 2008, right? And you can see that 90% have at least 10% equity in their home. What does that mean? They summarize, Black Knight summarizes in the report, the high level of equity today provides options for homeowners, policymakers, mortgage investors, and servicers in helping to avoid downstream foreclosure activity and default-related losses. So this question of how is unemployment going to affect the housing market is a big question right now. We know that forbearance was enacted to help people survive this economic storm, and yet it's causing people to say, quote, okay, could we see foreclosures coming to the market with the number of people that don't have a job? Close quote. So when we look at the Black Knight information, I want to talk about that for just a minute. Looking at the number of people who have significant equity, think about that. If you had a $400,000 home and you were in a situation where you couldn't make the payment and you had 20% equity in that home, that's $80,000. You would go out and sell that home before you'd allow it to go into foreclosure. I think applying that common sense to that equation is what we have to do today and back it up by the data. But unemployment story we're going to continue to watch. A lot of questions coming out of that. But seeing the overall unemployment rate come down, but the core unemployment rate ticks up just slightly. It causes concern and fears in the minds of people that we talk to. I want to go here really quickly from Lending Tree says, quote, 87% of home sellers are concerned their home won't sell because of the pandemic and resulting economic recession. That's a big number. 87%. 87%. Did I read that wrong? That's a big number. A lot of home sellers are saying, quote, I'm concerned about what's going on out there and afraid that my home won't sell. And yet, 372,000 homes were sold in the U.S. last month. We need to get that information out there. And we need to be able to communicate that the number of people that are looking for homes and buying homes today remains extremely strong. Mark Fleming at First American sums it up best this way. He says, quote, as we navigate the unprecedented impact of COVID-19, all homes have taken added significance. And there are signs that home ownership remains one of the main tenets of the American dream, the main core beliefs. What do we know there? We know that people are coming and saying, there are different things that we want in a home. And we're going to talk about that in just a little. It's one of the main tenets of the American dream, right? Even if we look at showing times, people continue to get back out there and look at homes, whether in person or virtually, depending on where they're at, right? Where they're located. As we saw the spike up in the months after we bottomed out in April, this continuation of showings and people saying, hey, we want to go out there and we want to look for a home, right? We'll talk about that more in section 3. Actually, apparently I can continue. My camera's going, so I'll keep going. As we go further into this, showing time says, quote, year over year, the change in buyer or viewer appointments has grown by 20.1.4% nationally. That's a big number, unquote. And you can see across each one of the regions, we see growths in showings, right? Growth in showings. NAR came out with a new study as well that really looks at several different things to say. How does the housing market look relative to recovery? And so they break down 4 things: demand, supply, price, and time on the market. And they've added to that factor to create a baseline and say, how are we doing overall to the recovery? And you can see we bottomed out in March, right? And then started to come back in April and May, not getting quite back up to that baseline of 100. So we dipped down and we didn't get back to 100, but headed in the right direction in an overall housing market recovery. We're coming back. So what do we see? We see the housing market starting a recovery. We know people are going out and looking at homes. And then even as we add in Zillow's information here, that newly pending sales are up 18.8% month over month, and listings taken are up 5.2% month over month. But here's the interesting thing. Total listings are down year over year, a little over 20%. And new listings taken are down 16.6% year over year. So as there's activity coming back in the market, there just isn't the available inventory in the market for those that want to buy. So we can see these things clearly. It's a year over year change in the listings, basically. New listings continue to grow. Total listings are decreasing. Meaning, as soon as they come to the market, they're being purchased, and we're seeing that. A sign of demand that's in the market right now. We've talked a lot about supply and demand, how that's working in the market. Basically, the inventories are tight. But those that are coming out saying, hey, the reasons we had for moving, the reasons we had for buying a new home have not changed. They're going out and they're buying the listings that are coming to market. Matter of fact, listings, this comes from the Z report, Z as in Z. Inventory as a percentage of households is half the long average. So the long-term average is 2.4%, and we sit right now at 1.2%. It's lower. An all-time low of the number of listings as compared to the number of households. So that's basically, I don't honestly know much about it, but that sounds to me like a inventory crisis. Right? It's an inventory crisis. All this comes together in the supply and demand question, saying, what is this going to do to home prices as we go forward? It's an interesting mix of pressures on price. I think as we look at what experts are saying right now, we have a look at 6 experts here that are saying, okay, as we look forward, what's going to happen with the pricing of homes this year? It's very difficult to predict when you have this many pressures moving in the market, but you can see the overall trends in effect. You can see here that home price expectations are in a slight decline in certain places. But 5 others say we will see appreciation. So a few are saying depreciation, 5 are saying appreciation. If we look at those 5, well, we'll see over 3% appreciation this year, over 3% this year. Then as we go into 2021 and 2022, we see appreciation across all those years. So across all the experts. So really, this is being driven by supply, inventory, and demand on the other side. The number of people coming out that want to buy homes, I think, is summed up very well by Ivy Zellman in her broker report. She says, quote, the severity of inventory tightness should remain a relative benefit to home prices, unquote. So that upward pressure on pricing. Quote, but it's also a risk factor to the degree of rebound in unit sales going forward. So the inventory is actually damping the rebound, interestingly enough. That's what I gather from what she's saying. So inventory literally being the lid of what we can go out and effectively rebound in the housing market because there isn't an available number of homes to sell there. We know that lack of supply is keeping upward pressure on prices. It's also, I suppose, dampening sales. If we look at this, we look at demand. High Frequency came out and said this, quote, the housing market is likely benefiting from low mortgage rates. I think that's a given. Stronger demand for larger spaces as more and more people work from home and desire to move away from crowded cities to avoid exposure to the coronavirus, or COVID-19 more correctly, which is one of many coronaviruses. Sorry, I'm getting sciencey. We know supply and where that's at and the upward pressure. We know demand. We're benefiting from lower mortgage rates. Simple, very simple, obviously. And why they would question that, I have no idea. Where literally people can go out today and say, hey, based on where mortgage rates are, we can now afford a home that we couldn't afford before. It's that simple. We can afford more of a home. And things are more important to us today that maybe weren't important 3 or 4 months ago relative to where we live and how we live. So they want more space so they can work more comfortably. They don't want to be stuck in cities and apartments. Fairly simple trend, urban to ex-urban. So as you look at pricing, we look at the supply and demand across the country. We're in an undersupply situation currently right now, could change. And then we know that demand is being spurred on by low interest rates. But let's talk about this trend. Realtor Magazine talked about it, of what people are saying is important to them now in a home, given the pandemic and given the last several months that we've experienced. They say this, quote, nearly 30% of the respondents they surveyed here in living in a high-density urban area say that the pandemic is prompting them to want to move by the end of the year. This is more than double the rate of those living in rural parts of the country where residents are much more likely to stay put rather than to relocate. So you're actually dampening people moving from rural areas, whereas they might have moved in the city, they're not moving in the city. People are not thinking about that. That interesting thought too. So what are they saying right here? People living in a denser urban areas want to get out and say, okay, we want to live in a less dense area. Maybe there are things that are important to them. If you're living in a condo or in a high-rise, and they say, I want a backyard for my kids. I want more space. I want something like that. We're seeing that reflective in the surveys that are coming back. As a matter of fact, buyers are showing a greater desire for these non-urban properties, and rural areas are leading the way as compared to suburban and urban. You can see in the study that 16% growth year over year increase. And views of properties in rural areas versus suburban and urban areas. That shift of this is now important to us as we look for a new home, going for space. And I think distance between houses and between each other, of course. Danielle Hale sums this up well, and she says, quote, much like the suburbs are gaining favor with home shoppers, second home markets are seeing increased interest from luxury buyers. Suffolk County, New York, home to the Hamptons, Palm Springs, Riverside County, California, and Greenwich and Fairfield County, Connecticut, all second home markets, ranked among the top 5 markets with the largest increase in listing view growth in May. Views of luxury properties accelerated 56% in the Hamptons, 28% in Palm Springs, and 24% in Greenwich compared to the January trends. That is highly significant. So we know that people are looking outside of the area that they're living in, and in this case, luxury markets are leading the way And people are saying there are things that are now more important to us in the place that we live. I think this overall trend is continuing. It's backed up by a Zillow report that was released. Quote, since the pandemic altered what buyers value in their homes, builders are predicting how future homes will change as a result and what people want most moving forward. As people spend more time during the pandemic, buyers are realizing which features of their home are working and not working. Unquote. Saying that this worked before for us, living in a small space, living this type of way worked for us, but now it doesn't. They also said, quote, home builders predict open concept floor plans will be a thing of the past as people now value more walls, doors, and overall privacy. That's a long-term trend, which is finally ending, actually, as far as I understand in the real estate market. Maybe different areas, but I know in Florida, New Jersey, even in I believe Europe, there's a tendency towards openness, right? It's that whole overarching trend is ending because they want privacy. They want people to get away from each other, I guess, in a way, because you're spending so much time at home. You want to have your privacy, not be all in the same room all the time. It makes sense. Okay, now where were we? The ability to work somewhere. Oh, I didn't finish the quote, I think. The ability to work somewhere and not be disturbed. Get on a Zoom call or get on some type of video call and not be out in the open is more important to people. I'm here in the middle of my dining room, disturbing the entire house, trying to keep everybody quiet while I make my videos. It'd be nicer to have doors and walls and private, more private spaces, right? Okay, they say, continuing on, quote, new construction, which offers the chance to really personalize home features, saw its listing page views grow by over 73% over last May. People want to customize. So I want to make sure I'm still video recording, and we are. It's going to be quite a long video, but we'll continue. We're seeing different things happen. People say that this is now important to me in the home, and that I'm looking for, and what I'm looking for, and the needs that I have for myself and for my family. This is what we need today. All as we look forward into the second half of the year and what people can expect. To that end, we are doing our next, I'll be doing more webinars later this week and this month, of course. I'm trying to put a video together for each month, basically, overall arching real estate trends as best I can, to the best of my knowledge. One person trying to lean on many other people's knowledge. What to expect in the second half of the year. We started several months ago into this, and even the last couple months bring a live reporting every single day, changing, right? Things are changing. Look at what's happening in the market and saying, we're going to make a commitment to work hard and get through this, right? Many people got a call from work. Some people are incentivized not to return to work. There's another fly in the ointment. If that ends with Congress saying no to the larger payouts, people will actually be more incentivized to go back to work. That is a fact. Of course, that doesn't really apply to certain places that have very, very low unemployment payouts. For instance, Florida has a very, very low unemployment payout. They want to work no matter what, basically. New Jersey, I know, is very different. The payouts are quite large here, and that may be disincentivizing people to work. Okay, so basically, trying to think what else I have to say. I have many, many ideas on this topic. One of the ideas is that if they don't, I think it's a given that they're going to have to, someone, either the president will have to do it by presidential decree, whatever he's going to do, someone has to end the evictions to avoid the foreclosures. Although there is equity in the market, evictions are never a good thing. No, it's not 2008. Nothing, history repeats, it's cyclical, but it doesn't repeat exactly, ever. There's no exact repeat ever. It just hints at a previous time, and it'll have things from different periods in time. So it's cyclical, but there's cycles within those cycles, right? So this is not 2008. This is not 1930. They're different times, way different factors. The main thing I would say to people is watch everything. Read everything you can, learn everything you can about the entire world, as the entire world impinges upon the USA, and that how everything happening in the USA impinges upon where you are. We're here in New Jersey, but people coming in from Florida will affect our pandemic rates. The COVID rates will be affected by states that are higher COVID, people moving to less COVID states. Yeah, that's not a good thing. So you have to watch everything. So you can't just watch your mortgage rate. You have to watch the stocks and bonds and precious metals and commodities to know the whole picture. And to do that, you have to look all around the world. Who are using those commodities? Who is using that gold? Who is looking into using Bitcoin? And I would say cryptocurrency is much more important than Bitcoin. Bitcoin to me is it's kind of a non-starter. Has several issues that make it extremely faulty, in my opinion. One of which I should mention to everyone is that whoever owns half the servers owns all the Bitcoin. So any country or any billionaire could buy, enough servers to have more than half the servers and thereby steal everyone's Bitcoin. That's a bad system. So I'll say Bitcoin is just the forerunner. It's the AOL. I think AOL is still around, but it's the Ma Bell kind of the first to the market. The other cryptocurrencies, I particularly like IBM Stellar. It's fairly, that's a tight ship. IBM Stellar was extremely well designed. It has, I think, a very, very good future. Nothing is perfect. There's no such thing as perfection, but it's very, very helpful, incredibly helpful in a web-based world. Electronic currencies, cryptocurrencies are going to do well. So you have to watch them as well. That's a trend. How is that going to affect the real estate market in the distant future, honestly? Before then, we're going to see all of the COVID effects. We're going to see the interest rate effects. We're going to see the stock market. There could be another crisis in the stock market, I'm thinking, because at some point, the disconnect between stock markets and Main Street has to be reconciled. The largest of the FANGs, the FANG companies, they're just so large, it's insane. They're larger than the economies of other countries. If you take the 4 largest FANGs, they are larger than, I think, every stock market on earth, except for like 2 or 3. 4 companies are larger than every stock market on earth, except 2 or 3 stock markets. The NASDAQ, the Japan market, and of course the NASDAQ are larger. But very few other stock markets with thousands, tens of thousands, hundreds of thousands of companies smaller than the top 4 countries, companies in the world. And they're not American companies. They're global, they're international global corporations, which have an inordinate amount of control of our United States lawmaking system through lobbies and candidates through campaign finance. You have to watch that closely. It's one of the things you have to watch closely. You have to watch everything closely. And of course, watch your local market, but your local market is affected by all the markets around it. New York City is now affecting our local Spring Lake market because people from New York want to move out of Manhattan and out of the city and move into rural places. Some of them want a very nice place. Some of them want a very inexpensive place. And that's what's causing all the bidding wars, et cetera, et cetera. Anyway, I have too much to add at this point. I could just ramble for another hour. So I'm going to leave you with that 24-minute July market wrap-up. I hope you find it interesting. Please comment below. Please contact me any way you want with questions. If you want to pick my brains about what I think, that's what we should be doing. We should all be picking everybody's brains. My opinions don't really matter so much as they can be contributed to other people's opinions. I would like to hear your opinion. Seriously, would love to hear more opinions on all of these topics and where you get them and how you think about them and what your sources are for your information, because the data is what drives good decisions, the data, the facts. I hope I've presented some facts here. And with that, I'd like to thank you for listening thus far. My name is James Graff. I'm with Advisors Mortgage Group, and that is not a mortgage minute. That is a mortgage half hour, or 25 minutes. I hope to see you again. I'm, of course, wish that you have an absolutely fantastic day. Thanks for listening. Bye.